This is a Tesla Model Y, the best-selling vehicle on Earth last year. Inside this car, there are 180 pounds of copper, wiring, motors, inverters, charging systems. There are 2.3 ounces of silver, contacts, switches, circuit boards. These two metals, more than lithium, more than cobalt, more than any other material, are the physical foundation of the electric vehicle revolution. Now here's what's strange. Tesla sold 1.8 million Model Ys last year. Multiply 180 pounds of copper by 1.8 million vehicles. That's 324 million pounds of copper consumed by a single car model. Multiply 2.3 ounces of silver by 1.8 million vehicles. That's 4.14 million ounces. One model, one company, 1 year. The world produced 22 million tons of copper last year. It sounds like a lot until you realize that electric vehicles, solar panels, wind turbines, AI data centers, and grid infrastructure are competing for every pound. The world produced 830 million ounces of silver last year. It sounds like a lot until you realize that 55% goes to industrial applications that are growing 12% annually, while mine supply grows 2%. These numbers are why Robert Friedland, the mining billionaire who discovered the world's largest copper deposit, said last week that copper will hit $15,000 per ton within 18 months. Why Keith Neumeyer, the CEO of First Majestic Silver, said silver will exceed $100 before it finds equilibrium. Why Goldman Sachs, in a research note that received almost no media attention, projected copper at $18,000 and didn't put an upper bound on silver. These aren't predictions from gold bugs or perma-bears or fringe commentators. These are projections from people who have spent careers understanding exactly how much metal the world needs and exactly how little the world produces. And they're all saying the same thing. We haven't seen anything yet. Here's what they're not telling you. The copper and silver bull case isn't about speculation. It isn't about monetary demand or safe haven buying or any of the traditional reasons precious metals move. It's about physics. About the physical requirements of technologies that governments have mandated, corporations have committed to, and consumers have adopted. Electric vehicles require 3.5 times more copper than internal combustion vehicles. A Tesla has 180 pounds. A Toyota Camry has 50 pounds. Every EV that replaces an ICE vehicle is a net addition of 130 pounds of copper demand. Global EV sales are projected to reach 40 million units by 2030. That's 5.2 billion additional pounds of copper demand, 2.3 million tons, just from the vehicle transition. Solar panels require 5.5 tons of copper per megawatt of capacity. The world added 510 gigawatts of solar in 2025. At 5.5 tons per megawatt, that's 2.8 million tons of copper. Wind turbines require 4.7 tons per megawatt for onshore installations and 15.5 tons for offshore. Add another 1.9 million tons from wind build-out. AI data centers, the infrastructure powering ChatGPT, Claude, and every other large language model, require 30,000 pounds of copper per megawatt of computing capacity. Microsoft alone is building 50 new data centers through 2028. Google is building 40. Amazon is building 35. The AI build-out is consuming copper at rates that didn't exist in any demand forecast published before 2023. Grid infrastructure ties it all together. You can't charge 40 million EVs on grids built for 1990s demand. You can't connect gigawatts of solar and wind without transmission lines and transformers and substations, all of which require copper. The International Energy Agency estimates that grid investment must triple by 2030 to support the energy transition. Every dollar of grid investment contains copper. Hundreds of billions in grid spending means millions of tons of copper demand. Add the numbers. EVs, 2.3 million tons of new annual demand. Solar, 2.8 million tons. Wind, 1.9 million tons. Data centers, 1.2 million tons. Grid infrastructure, 2.1 million tons. Industrial growth in emerging markets, 1.5 million tons. Total new demand by 2030, approximately 12 million tons annually, on top of current consumption of 26 million tons. The world needs to produce 38 million tons of copper per year by 2030. Current production is 22 million tons. The gap is 16 million tons, 73% more copper than the world currently produces. That copper does not exist. This is where the lie becomes unsustainable. The supply response that would close a 16 million ton gap cannot happen in the time available. Copper mining doesn't scale like software. You can't download more copper from the cloud. You can't 3D print it. You can't substitute aluminum or plastic for most applications where copper's conductivity is required. New copper mines take 16.5 years from discovery to production. That's not bureaucratic delay, that's the physical reality of building roads to remote locations, constructing processing facilities capable of handling millions of tons of ore, securing water rights in regions where water is scarce, and navigating regulatory approvals in jurisdictions that increasingly view mining as environmentally unacceptable. The mines that will produce copper in 2030 were approved in 2014. There weren't enough of them. The mines that could have been approved in 2014 were blocked, delayed, or abandoned because copper was trading at $6,000 per ton and the economics didn't work. Now copper is trading at $9,400 per ton, but the projects that weren't built then can't be built in time for when we need them. The existing mines are depleting. Average copper ore grades have fallen from 1.5% in 1990 to 0.62% today. Miners must move 2.4 times more rock to produce the same amount of copper. This requires more energy, more water, more equipment, more time. The productivity decline in copper mining has been 2.3% annually for the past decade, meaning each year it takes more effort to produce the same output. Chile, the world's largest copper producer, saw production decline 6% last year due to water shortages and ore grade depletion. Peru, the second largest, faces ongoing social conflicts that have shut mines and delayed expansions. The Democratic Republic of Congo, the source of much of the world's cobalt and increasingly its copper, is politically unstable in ways that threaten supply reliability. The supply curve is bending downward, while the demand curve is going vertical. The intersection of those curves, the price at which supply and demand balance, isn't $9,400 per ton. It's not $12,000 or $15,000. It's whatever price destroys enough demand to match the supply that actually exists. Goldman Sachs' $18,000 target isn't a ceiling. It's their estimate of where demand destruction begins. The price at which manufacturers start canceling projects, automakers delay EV targets, and grid investments get deferred. At $18,000, some demand goes away. Below $18,000, the shortage persists. Now multiply this logic for silver. Silver's supply-demand imbalance is arguably worse than copper's. Silver mine production has been flat for a decade, stuck at approximately 830 million ounces annually, while industrial demand has grown from 450 million ounces to 580 million ounces. The deficit has been filled by recycling and above-ground inventory drawdowns, but both sources are finite. Solar panels alone consumed 161 million ounces of silver in 2024, up from 70 million ounces in 2019. Each solar panel requires approximately 20 grams of silver for its electrical contacts. As panel efficiency improves and installations accelerate, silver demand from solar is growing 18% annually. By 2030, solar alone could consume 300 million ounces, more than a third of total mine supply. Electric vehicles add another layer. Each EV contains 25 to 50 grams of silver in its electronics, battery management systems, and charging components. At 40 million EVs annually by 2030, that's another 50 million ounces of demand. 5G infrastructure, medical devices, water purification, antimicrobial applications. Silver's unique properties make it irreplaceable in applications where conductivity, reflectivity, and antibacterial characteristics are required. Industrial demand is growing across every category, while mine supply stagnates. Unlike copper, silver has a monetary dimension that amplifies price moves. When industrial users compete with investment demand, when people buying silver as a store of value compete with manufacturers who need it for production, the price discovery becomes explosive. Silver's historical volatility exceeds copper's by a factor of 3. Moves that seem extreme in copper are normal in silver. Keith Neumeyer's $100 target assumes current supply-demand trends continue. It assumes no supply disruption, no investment surge, no monetary crisis that drives safe haven demand. Under stress scenarios, where any of those factors materialize, $150 becomes the floor rather than the ceiling. When the people who control supply tell you prices must rise dramatically, they're telling you something markets haven't priced. Robert Friedland didn't become a billionaire by being wrong about copper. He discovered the Voisey's Bay nickel deposit. He developed the Oyu Tolgoi copper mine in Mongolia. He's currently developing Kamoa Kakula in the DRC, the highest-grade major copper discovery in decades. When he says $15,000 copper is coming, he's not guessing, he's calculating. At 9:30 a.m. Eastern on Tuesday, Friedland addressed the Mining Indaba Conference in Cape Town. His presentation included a chart showing cumulative copper demand from the energy transition through 2035 versus identified supply from existing mines and approved projects. The gap was 112 million tons. 112 million tons of copper that doesn't exist, hasn't been discovered, and cannot be brought to market in time even if it were discovered tomorrow. The world is sleepwalking into a supply crisis, Friedland told the audience. The prices we see today are not high, they're low. They're prices that assume supply will materialize from projects that don't exist, using capital that hasn't been committed, building mines that haven't been permitted. The repricing, when it comes, will be violent. That word, violent, isn't hyperbole. Commodity markets that discover shortages don't adjust gradually. They spike, they overshoot, they rise until demand destruction restores balance. Then they stay elevated because the supply response takes years to materialize. The uranium market provided a preview. After years of low prices and underinvestment, uranium quadrupled from $30 to $106 per pound between 2021 and 2024. The supply gap was smaller than copper's. The demand growth was slower. The price response was still a 250% increase. Copper's fundamentals are tighter. Silver's fundamentals are tighter still. Less than 11 months remain in 2026. Goldman's $18,000 copper target is for this year, not 2030, not 2035, this year. The supply-demand arithmetic that drives that target is visible in the data that mines, smelters, and manufacturers publish every month. The arithmetic isn't speculative, it's subtraction. Demand minus supply equals shortage. Shortage plus inelastic supply equals higher prices. Some will look at these price targets and see hype. We'll assume that forecasters always exaggerate. We'll trust that markets are efficient, and if $18,000 copper were coming, it would already be priced in. We'll believe that technology or substitution or demand adjustment will prevent the scenarios that miners and analysts describe. These are the same voices that said oil would never exceed $100 again after the 2014 crash. That said lithium prices would stabilize after 2022's spike. That said supply chains had been stress tested and secured. The voices are always skeptical of shortage scenarios, until shortages arrive and the skepticism looks like denial. Others will read Friedland's presentation. We'll track the IEA's copper demand forecasts. We'll count the solar installations and EV sales and data center construction and calculate the metal requirements for themselves. We'll notice that mine supply has grown 2%, while demand has grown 8%, and ask how long that arithmetic can continue before prices force a reconciliation. The informed are not predicting that copper will hit $18,000 or silver will hit $150 on any specific date. Predictions require timing precision that commodity markets don't provide. What the informed recognize is that the gap between supply and demand is real, is widening, and must eventually close through either price increases or demand destruction. The transition technologies that governments have mandated and corporations have embraced require metal that doesn't exist at current prices. Either the prices rise to incentivize supply and ration demand, or the transition fails. This is not financial advice. This is not a recommendation to buy copper futures or silver bars or mining stocks based on price targets from industry participants with obvious interests in higher prices. This is simply a description of arithmetic. The arithmetic of how much metal the energy transition requires versus how much metal the mining industry can produce. The Tesla Model Y will still be built next year. The solar panels will still be installed. The AI data centers will still be constructed. The question is what those projects will pay for the copper and silver they require, and whether the prices that balance supply and demand are the prices we see today, or the prices that Friedland, Neumeyer, and Goldman Sachs are projecting. $18,000 copper, $150 silver. Numbers that sound extreme until you calculate the gap, until you count the mines that weren't built, until you measure the ore grades that are falling, until you add the demand that policies have created against the supply that geology constrains. It's just the beginning, Friedland said in Cape Town. The world hasn't figured out yet what it's going to cost to build the future it's already committed to. The arithmetic suggests he's right. The supply doesn't exist, the demand does, and the price that reconciles those two facts hasn't been discovered yet.